Well, last week was a solid week and an otherwise rocky start, I guess, to the year in terms of the first quarter anyway. So it was nice to see that. And the Fed did put on a happy face and we got some good news. So let's dive into the story behind all that. So this is your Market in Minutes report. I am Mike Minter, Chief Investment Officer with Financial Synergies. We're looking back, of course, on last week, which was March 17th through the 21st. And so let's dive into the data behind this. I will grab my laser pointer here. So across the board, a good week, solid. Obviously, Nasdaq was not as good as the broader markets, but still in positive territory. And international stocks continue to do really well and even outperform the domestic broader markets. And we'll talk a little bit more about that on this next data point, which is your year-to-date performance. So as we're kind of backing out and looking at the full picture here, obviously been a little bit of a rough start to the year just in general. At one point, we did hit correction territory on the broad market. So the S&P 500 at one point was down around 10%, and the Nasdaq as well. So we've come off of that, which is good to see. But there's a broader story here, which is kind of cool to see. So this has largely been driven, the downturn anyway, by a tech sell-off. So tech, think Magnificent Seven, all the household names, NVIDIA and Meta and so forth, have kind of backed off this year. So after really being the hot spot for the last few years, the valuations have gotten stretched. And so anytime you start to see little cracks appear, it's generally going to be the high flyers are the first to get hit, which is exactly what's happened. Now, again, I'm not worried about this. I don't think we're in any real danger of falling off a cliff. But what you are seeing is the breadth of the rally. If the rally does kind of reinvigorate itself and get back to the bull market phase, what you've seen is a real broadening out of the market participation. So in other words, it's not just about tech anymore. It's about value stocks. So think more, banks and energy and things like that have really been the laggards over the last few years. And you're also, what's nice too, is you're also starting to see international stocks. So check this out. The MSCI EAFE, which is foreign developed stocks, is up over 10% for the year. And at one point was up over, I think, 12%, 13%. So this is really nice to see. I know this has not been a fun place to be over the last few years. International versus US has really been a lagging, a laggard in your portfolio, but that has turned big time this year. So we're really happy to have them, of course, in the portfolio, along with bonds. So bonds are not on this slide, but bonds have actually done really well this year. And so you have a lot of very diversified portfolios right now that are firmly in positive territory on the year, thanks to things other than just exposure to large cap domestic stocks, which are largely driven by tech at this point, being the largest concentration in those indices. So again, very nice to see, especially on the international side, that they are doing quite well in this environment. So something at least positive to talk about. The other positive thing to talk about is rates. Rates have, if you were to watch the financial media or really any media these days, you'd think that the sky was falling and that everything is doom and gloom. And it's just not. It's not true. Economic picture is still okay, and rates have actually come down. So across the board, you're seeing 30-year, 10-year, 2-year all coming down, and the 30-year mortgage rate is now down to 6.75%, 6.75%. So again, very good for the housing market, especially if you're looking to get into your first-time home. So these rates continue to come down, and if that continues to happen, that should loosen things up in terms of people selling and kind of just adding some oomph to the housing market, which has been so stale for the last few years. So across the board, again, yes, year-to-date performance is down, but there's a lot of positive factors going on right now that are influencing the market beyond just the tech sell-off. So let's get into kind of the story behind last week. So we did have a solid week. As we've seen, the numbers are good. Stocks opened the week higher despite weaker than expected retail sales. And on Tuesday, stocks pulled back on disappointing economic and data and renewed Middle East tensions. Stocks were higher Wednesday as investors looked forward to the Fed's meeting And as widely expected, the Fed kept rates steady, but Fed Chair Powell's comments are what really buoyed investors' spirits. So stocks dipped Thursday and opened lower Friday, but investors showed some confidence by pushing prices higher into Friday's close. The Fed, again, did stay positive. So this is where that happy talk comes into play. So amid all the market turbulence of late, the Fed was a steadying influence. So at his post-meeting conference, Fed Chair Powell stressed that the economy remains strong and suggested that any impact from tariffs on inflation would be short-term in nature. So, but really the primary reason investors cheered came down to this. Most Fed officials still are penciling in 2 interest rate cuts for the year. So that's good. That was what we expected, and that's still sounds like that's still going to be the case. In late January, Powell said the central bank was in no hurry to adjust its policy stance, which unsettled the markets. And now we get a more steadying kind of comment in that we'll probably have 2 rate cuts this year. I mean, that's always subject to change, but it did calm the markets last week. So that was a positive. What's on deck this week? We've got some key economic data starting today. PMI Composite, services and manufacturing. Tuesday, Case-Shiller Home Price Index, consumer confidence and new home sales. That's a big one. Wednesday, durable goods orders. And we have Fed President Alberto Mussolem speaks. That's the St. Louis Fed president. Thursday, GDP, trade balance and goods, weekly jobless claims, retail wholesale inventories, and pending home sales. And then we also have Tom Barkin speaking from the Fed. Friday, we have personal consumption and expenditures and consumer sentiment. So pretty big week for data. Corporate earnings are winding down, obviously, as we end the quarter, last week of the quarter. So pretty slow there. But Tuesday, McCormick, GameStop. Wednesday is Cintas and Paychex. And then Thursday, we have Lululemon. So that rounds out the data and earnings for the week. So that's it, folks, for the report. So as always, this is our contact information. If you need to get in touch with us for any reason, whether you're a client or otherwise, please do so. Any of these methods will work. Also, hit that subscribe button down below if you haven't already. Get our YouTube videos as they come out. And beyond that, I'll leave you a little light disclosure, but I will check in with you next week and report back on hopefully what is good news for this week. Okay, guys, thanks. Have a great week.